Hi, my name is Chris Bell, and I'd like to give you 5 reasons not to buy Facebook stock. Reason number 1, they've only been in business for 14 years. 14 years seems like a long time depending on how old you are. I'm only 35 years old, so 14 years is actually quite a long time. But in the business world, in terms of buying different companies and buying different stocks, I like to look at companies that have been in business for 100 years. And companies like McDonald's and Coca-Cola, Disney World, they've been in business so long that they've had multiple CEOs. And Mark Zuckerberg is so far the only CEO of Facebook, and his vision has been great, and the company has been growing. The balance sheet is positive, and the income statement is positive. They're doing a great job. They're making a lot of money. They have very little debt. So all of these things are positive, and I agree with all of that. But the price of Facebook has gone up so high that it's no longer worth what they have on the balance sheet. So they have billions of dollars and they're making billions of dollars, but it costs billions of dollars more to buy the company. So number 1 is that they've only been in business for 14 years. They've only had one CEO. I like to see multiple CEOs. I also like to see that the company has made it through all kinds of recessions and depressions, technological changes in the world, the industrial revolution, different revolutions, multiple presidents, all kinds of different things going on in the world. And some companies made it through all the thick and the thin that we've been through. And some companies are newer, and there's nothing against Facebook. They just haven't really gone through really hard times yet. So that's reason number 1. Reason number 2 is the balance sheet. Facebook's balance sheet is very positive. They have $80 billion. If Mark closed the doors today and fired all of the employees and stopped running Facebook, just closed everything down, he could sell all of the assets, pay off all the liabilities, and end up with $80 billion. So he's doing very well for himself, and that $80 billion would be split between all the shareholders, and however many he owns, he would get. That's all great. But the fact that it's $80 billion doesn't just mean, oh, there's $80 billion, I would like to buy that stock. You have to compare it against the market cap. So I could buy Facebook from Mark today at the current price of $165 per share, and it would cost me $476 billion. And tomorrow, if I close the doors, I would only get 80. So I would have to be making a lot of income to get back up and make sure that I get all of my money back. So right now I'm in the hole big time. I just spent $476. I bought Facebook. I'm running it now. Mark Zuckerberg is gone. I only have 80 billion, so I can't close the doors because I would lose $400 billion because it costs almost 480 to buy it, and I only have 80 if I close the doors. So we're gonna have to look at the income statement because the balance sheet doesn't look so good against the market cap right now. Reason number 3 not to buy Facebook is the income statement. And it may seem a little strange what I'm about to say, but the net income of Facebook went from 3 billion to 3.6 billion to 10 billion to 15.9 billion in the last 4 years. And in 2018 right now, they've only been through about 3 quarters, but if you look at the last 4 quarters, Facebook, it looks like they're going to make about $20 billion. So it just keeps going up, and it seems like it can't stop going up, but it usually does. It will plateau eventually. And when you look at the average earnings over the last 4 years, it would be a lot closer to 8 or 9, even 10. But let's just take the peak, $20 billion. Let's assume that we still bought Facebook for 480 and we have 80. We need to make back the 400. So if they're making 20 per year, that's net income after everything. So the net income is 20 at the highest level they've ever been. Right now, looking at the last 4 quarters, which is a really bad idea to do a calculation on, but let's just take best case scenario. $20 billion times 5 is 100. So you take that and you have to multiply that times 4. So you're talking about 20 years to get your money back. If you pay 480 billion right now for Facebook and you have 80 to liquidate with, all your assets, all your cash, everything that you have, $80 billion, and then you're making 20 per year, you're gonna go to 100, and then 120, and then 140. It's gonna take you 20 years to get to 480, which means if you bought one share at 165, that you could only liquidate it for about a fifth of that, which is much, much less. And if you really wanted it, I just think it's a very high risk to buy a company at $165 per share, buying a company for almost $500 billion when they only have 80 and they're only making 20. When you say that a company is making $20 billion, you just think, like, how can you even do a calculation on that? It's so much money. But there is a very simple calculation to do. You buy a company for 480, you have 80 left. That means you need to make 400 back because you took 480 of your own and gave it to somebody else. So you have to make that money back, and it's going to take 20 years, which is an interest rate of like 4 or 5% at best, and that's compounding. So it is just a bad idea to jump into Facebook right now. It's a high risk. Reason number 4, the cash flow statement. I like to look at about 3 lines or 4 lines on the cash flow statement at the bottom. When you get into the financing activities, you'll see a dividend and whether Facebook is giving a dividend or not, and right now they are not. So the only reason to buy Facebook stock right now is in hopes that it will appreciate, and I don't really like to buy things based on appreciation. For example, I don't buy a house because I hope it's going to double in price and I can sell it. I buy a house because I'm going to put a down payment down and I'm going to collect rental income to pay off the down payment that I had and continue collecting that rental income. So I like to look at the return on investment, and they just don't pay a dividend at all. So I usually neglect those stocks right away. The second thing is, if you look at the net borrowings, you can see that Facebook is either borrowing money, which increases their cash, or they could be paying off their debt, which is minusing their cash. They subtract some cash from the bank and pay off the debt that they have. So they're not doing either one. In the last 4 years, they haven't taken on any new debt and they haven't paid off any debt. So great for them. A lot of companies are really trying to scale fast and taking on new debt to buy other companies, to acquire other companies, and maybe it works, maybe it doesn't, but either way, Facebook's not doing either one, so that's good news. The last thing on the cash flow statement is buying back their shares, and Facebook's not doing that either. So as a shareholder, you kind of hope that they're going to spend the money either by giving some back to you as a dividend, or they're going to pay down their debt, or they're going to buy back some of the shares, which ends up making your shares worth a little bit more. So all of those things are benefits to the shareholder, and Facebook's not doing any of that. So they went public, they had their IPO, they took a bunch of money from people, they invested it, and the share price went up, which is great, but they have to give some back every once in a while to the shareholders who got them to where they are. And to me, I lose a little bit of faith and I lose a little bit of trust in a company that's not giving anything back to the shareholders, especially when they're making $20 billion. They're making $5 billion a quarter right now, and they can't give anything back to the people that got them there and the people that continue to hold their shares and keep them long term. They're not getting anything. They're just holding the shares. It's like holding gold right now. You're hoping that it appreciates, and that's it. So it's another reason that I just don't like Facebook stock. The fifth and final reason to not buy Facebook stock is that they have $20 billion of goodwill and intangible assets on their balance sheet. So I've been saying that you can buy the company for 480 and Facebook has 80 on their balance sheet. Well, it's actually $20 billion less than that, down to 60 because of the goodwill. If Facebook actually wanted to close their doors and sell everything, they could sell their property, they could take the cash out of the bank, they could take all of their receivables, anything that's an asset, and they could pay off their liabilities, and it says that they would have 80. But the net tangible assets, they actually only have 60 because the goodwill happens when you buy a company for more than the book value. And if you buy a company for more than the book value, which Mark must have done along the way, he paid $20 billion more than the book value of a company when he bought it, and it's on his balance sheet as goodwill, and they assume that the income over the next 10 years is going to make up for that. But if 10 years go by and it doesn't, well, it's still sitting there. So I would say that Facebook right now is worth $60 billion. That's their book value, plus 3 years of earnings, which at their maximum right now is 20 plus 20 plus 20, so that's 60, plus the original 60 is about $120 billion, not 480. So that's divided by about 4. So if you divide the 160 share price by 4, you end up at about $40 per share that I would buy Facebook for, but I would not buy it at $165.